Welcome. Awer, Anda, Dumalang, Molo, Sowabona, Hukandet, and a warm welcome to the Indubo Knowledge Cast, the podcast where your curiosity meets insightful conversations. Today, we're taking a deep dive into the world of business combinations. You know those mergers and acquisitions? The ones that shake up the corporate landscape. And we'll be looking at it all through the lens of IFRS 3, the International Financial Reporting Standard. It sets the rules of the game, really.
Yeah, that's right. So we'll be breaking down the jargon and exploring how IFRS 3 helps us understand the financial impact of these big business deals, even if you don't spend your days, poring over balance sheets.
Now, before we get into the nitty-gritty, let's set the scene. Imagine two companies, each with their own assets, liabilities, and that special something that makes them tick. Suddenly, they decide to join forces, kind of like a Shisanyama joint merging with a space emporium. But instead of worrying about who's playing the pap and who's got the chakalaka, we're talking about millions, even billions of rands.
Exactly. And IFRS 3 is there to make sure those financial ingredients are measured and reported accurately. It's about transparency, so everyone understands the financial recipe of the newly combined entity.
Okay, so let's start with the basics. What exactly IFRS 3 is a business combination? According to IFRS 3, I mean. It can't just be any old handshake deal, right?
You're right. It's not just about shaking hands and sharing a castle light. IFRS 3 is very specific. A business combination happens when one company, the acquirer, gains control of another company, the acquiree. Think of it like a game of chess. One player makes a strategic move and takes control of the board.
So we're not just talking about a friendly partnership. It's about who's really calling the shots. And that brings us to the question of identifying the acquirer. Is it always as clear-cut as it seems?
Not always. Sometimes it can be tricky to figure out who's holding the reins. That's where IFRS 10 comes in handy. Think of IFRS standards like a toolbox. IFRS 3 handles the combination itself, while IFRS 10 helps us identify the right tool for the job, so the acquirer.
All right, so IFRS 10 is like our trusty spanner, helping us tighten those loose bolts and figure out who's truly in control. And I bet there are times when a seemingly smaller company ends up as the acquirer, right?
Absolutely. Those are called reverse takeovers, and they can be fascinating. Imagine a small, innovative tech startup swallowing up a lumbering corporate giant. Talk about David and Goliath,
Yeah.
but with share certificates instead of slingshots.
Love it. So we've got our acquirer, our acquiree, and a whole lot of financial shuffling going on. But there's another key element here, the acquisition date. Now, this isn't just the day they pop the champagne and sign on the dotted line, is it?
No, it's a bit more nuanced than that. The acquisition date is the day the acquirer actually gains control of the acquiree. And that's crucial for reporting purposes. Sometimes it might coincide with the closing date, but other times control might be transferred earlier, perhaps through a written agreement. It's about pinpointing the exact moment those financial destinies intertwine.
It's like knowing the exact moment a new Springbok coach takes over, when the game plan changes and those players start feeling the pressure. Okay, so we've got our players, our acquisition date, and a whole lot of financial maneuvering ahead. But how does IFRS 3 actually guide companies in reporting all of this? It's got to be more than just adding up numbers, right?
Right. It's not just about simple arithmetic. IFRS 3 mandates the use of the acquisition method for reporting business combinations. Think of it as a recipe, a step-by-step guide for financial reporting. First, we identify the acquirer, then pinpoint that acquisition date. Then we carefully list all the assets and liabilities coming into the mix, including any non-controlling interests, those shareholders who aren't part of the controlling party. And finally, we arrive at that mysterious ingredient called goodwill.
Goodwill. That word gets thrown around a lot in the business world. But what exactly is it in the context of IFRS 3, I mean? It's not just about being nice to your colleagues, right?
Not quite. Imagine you're buying a successful shebeen, a place with loyal customers, a great vibe, and maybe even a legendary bunny chow recipe. You're paying not just for the physical building and equipment, but also for those intangible elements that make it special, that attract customers and generate profits. That's essentially what goodwill represents, the value beyond the tangible stuff.
So goodwill is like that intangible it factor that makes a business stand out from the crowd.
Exactly. And IFRS 3 requires companies to recognize goodwill separately because it plays a crucial role in understanding the true value of the combined entity. But it's not a free-for-all. We need to carefully measure those assets and liabilities that come with the acquisition. And IFRS 3 is very specific about using fair value at the acquisition date.
Fair value. So we're not talking about some arbitrary number pulled out of a hat. It's got to reflect what those assets and liabilities are actually worth in the real world, right?
Absolutely. It's the price you'd expect on the open market, considering all the relevant factors. And this definition of fair value aligns with the conceptual framework for financial reporting, ensuring consistency across all IFRS standards. We need to make sure we're comparing apples with apples, you see, not mixing up side deals with the main course of the business combination.
Okay, so we're meticulously valuing everything at its fair value, figuring out goodwill and making sure everything is above board. But let's dig a bit deeper into those hidden treasures and potential skeletons in the closet. What about those intangible assets that aren't as obvious as a secret bunny chow recipe? What about things like brand recognition, loyal customers, or even a killer location? How do those factor into the equation?
You're spot on. Those are all examples of intangible assets, and IFRS 3 requires us to recognize them separately from goodwill. Think about a brand like Nando's. Their name, their cheeky personality, their peri-peri sauce. Those are all intangible assets that add immense value to the business, even if you can't physically touch them.
Right, so we're talking about those intangible elements that give a business its unique flavor and attract those loyal customers. But how do we go about valuing something like brand recognition or customer loyalty? It's not like there's a price tag hanging on them, is it?
It can be tricky, but that's where valuation techniques come in. We look at market data, comparable transactions, and even future income projections to try to put a fair value on those intangible gems. It's a bit like trying to value a piece of art. It's subjective. But there are methods to the madness.
Okay, I'm starting to see how IFRS 3 helps us uncover the full picture of a business combination. It's not just about crunching numbers, it's about understanding the true worth of those intangible assets that can make or break a business. But what about the flip side? What about those potential financial landmines that might be lurking beneath the surface?
You're talking about contingent liabilities. Those are the potential obligations that might arise depending on certain events. Think of it like this. You buy a beautiful house, but later discover there's a hidden leak in the roof, the one that needs expensive repairs. That's a contingent liability, a potential cost you didn't anticipate.
So it's like those unexpected potholes on our South African roads. You never know where you're going to hit one. And how does IFRS 3 address these contingent liabilities? Surely companies can't just ignore them and hope for the best.
Of course not. Transparency is key. IFRS 3, in conjunction with IAS 37, provides guidance on recognizing and measuring those contingent liabilities. It all comes down to the probability of those liabilities actually occurring and the ability to reliably measure their fair value.
So even if it's not certain a company will have to pay out for a potential lawsuit, they still need to acknowledge that possibility in their financial reporting. It's like those disclaimers you see on TV ads. Terms and conditions apply.
Exactly. IFRS 3 is all about presenting a complete and transparent picture of the combined entity's financial position. Investors and creditors need to know about those potential potholes, those hidden leaks, before they decide to invest their hard-earned rands.
Okay, I'm getting a real sense of the depth and complexity involved in applying IFRS 3. We're not just adding up numbers, we're unearthing those hidden gems and potential landmines. But before we move on, I have to ask, what about those times when a company seems to score an incredible deal? Like finding a backy load of borrowers for a steal. Does IFRS 3 have anything to say about those bargain purchases?
It does. A bargain purchase happens when the net value of the acquired assets is actually higher than the price paid for them. It's like hitting the jackpot in the business world. And IFRS 3 is very clear. You can't just sweep that extra value under the rug. You need to recognize that gain.
So no hiding those lucky finds. But before we start celebrating, I imagine there's a catch. Companies probably need to double-check they've accounted for everything correctly before declaring a victory.
Right. Absolutely. Before recognizing that gain, you need to scrutinize every nook and cranny. Make sure you haven't overlooked any hidden liabilities or underestimated any assets. You don't want to be caught celebrating a bargain, only to discover you've inherited a mountain of debt or a legal headache.
It's like making sure there's no expiry date on that Borwares before you throw it on the braai. So thoroughness and transparency are key when it comes to IFRS 3. Now, before we move on to the next chapter of our IFRS 3 saga, I want to pose a question to our listeners. Why should the average person care about all this accounting jargon? It's not like we're all analyzing balance sheets every day, are we?
That's a valid question. But here's the thing. IFRS 3 isn't just about numbers and spreadsheets. It's about ensuring fairness, transparency, and accountability in the business world. When companies follow these standards, it levels the playing field and allows investors, creditors, and the public to make informed decisions.
Right, so IFRS 3 isn't just for the accountants in their ivory towers. It has real-world implications for all of us.
Exactly. Think of it this way. IFRS 3 helps shine a light on the inner workings of those big corporate deals, ensuring everyone has access to the same information. It helps protect investors from being misled and promotes a healthy, transparent business environment. And that benefits all of us in the long run.
Okay, that makes sense. So IFRS 3 is like that trusty traffic cop directing the flow of information and making sure everyone plays by the rules. And understanding those rules can empower us to make more informed decisions, whether we're investing in the stock market or simply trying to understand the financial landscape around us.
Exactly. And remember, even if you're not a financial whiz, grasping the basic principles of IFRS 3 can be incredibly valuable. It can help you decode those financial statements, understand the impact of mergers and acquisitions, and see the bigger picture behind those corporate shakeups.
Now, that's what I call empowering knowledge. So stay tuned, folks, because in the next part of our deep dive, we'll be exploring the reporting requirements of IFRS 3, those detailed disclosures that help us uncover the story behind those big business combinations.
We'll be unpacking those disclosures, examining goodwill in more detail, and even delving into some of those exceptions to the rules, the ones that make IFRS 3 so fascinating.
Don't touch that dial.
Welcome back to the Indubo Knowledge Cast. Before the break, we were talking about IFRS 3, acting as a guardian of transparency in the realm of these business combinations. Now, let's shine a light on those reporting requirements, because the devil, as they say, is in the details.
That's right. IFRS 3 is like those high-intensity floodlights at Moses Mabhida Stadium, illuminating every corner of the financial field. So, what kind of information are we talking about here? What does IFRS 3 force companies to reveal?
We'll think of it as a detailed recipe for the business combination. IFRS 3 requires companies to disclose a whole lot of specifics, starting with the basics, the names and descriptions of the companies involved, the acquisition date, the percentage of voting rights acquired, and crucially, the reasons behind the combination.
So it's not just about the cold, hard numbers. We also need to understand the why behind these corporate tangos. Are they merging to conquer the market? Or is one company swallowing another to eliminate the competition? Big difference.
Precisely. Those motives can have a ripple effect on the combined company's future, and investors need to know what's driving those decisions. But that's not all. IFRS 3 also demands details about how the acquirer gained control, any special arrangements that were made, and a breakdown of the consideration paid, whether it was cash, shares, or perhaps even a promise of future buybacks.
Now that's a deal sweetener I can get behind. But jokes aside, this level of detail makes sense. It's like checking under the hood of a taxi before you hop in. You want to know what you're getting into and whether it's going to get you where you need to go.
Exactly. All of this information helps investors, creditors, and analysts piece together the puzzle and understand the true financial implications of the combination. But hold on, there's more. IFRS 3 also requires companies to spill the beans on any contingent consideration.
Contingent consideration. Those what-if scenarios that can make or break a deal. Remind us what that is again.
Imagine a promising local tech startup, the one that gets acquired. And the deal includes an extra payout if they hit a certain number of users within a year. That extra payout is contingent consideration. It hinges on future performance. Kind of like those performance bonuses in rugby contracts.
So it's like getting a bonus for scoring a try against the All Blacks. The stakes are high.
Exactly. And because these contingent payments can significantly impact the final cost of the acquisition, IFRS 3 demands transparency. Companies have to describe those arrangements, how those payment amounts are determined, and even give an estimate of the potential range of outcomes.
So no hiding those bonus clauses. And I imagine this applies to those indemnification assets too, right? Those financial safety nets that protect against unexpected bumps in the road after a deal.
Absolutely. Indemnification assets, just like those contingent considerations, need to be clearly explained and accounted for. IFRS 3 leaves no stone unturned, ensuring that every potential financial twist and turn is brought to light.
Okay, we're getting a clear picture of the granular detail that IFRS 3 requires. But let's zoom in on one of the most intriguing aspects of business combinations: goodwill. Earlier, you explained how it captures the value beyond the tangible assets, like a company's stellar reputation or its loyal customer base. But how does IFRS 3 handle goodwill in the long run? It's not like a piece of equipment that depreciates over time, right?
You're right. Goodwill doesn't depreciate like a delivery van or a computer, but it can lose value, especially if those anticipated benefits of the business combination don't materialize. That's why IFRS 3 requires companies to regularly test goodwill for impairment.
Impairment. So basically checking if that goodwill is still as shiny and valuable as it was on day one.
Precisely. Imagine a popular beachfront restaurant that gets hit by a sudden erosion problem, shrinking the beach and scaring away tourists. Suddenly, that prime location goodwill isn't worth as much. Companies need to be realistic and adjust the value of goodwill if those circumstances change.
Ag shame. That's rough. So they can't just sit back and assume that goodwill will stay strong forever. They need to keep a close eye on it.
Exactly. And if an impairment is identified, the company has to reduce the carrying amount of goodwill on their books and recognize a loss. It's about keeping things real and reflecting the true economic reality of the situation.
This makes perfect sense. But how do they actually go about testing for impairment? It seems like a tricky task, to put a number on those intangible values.
It can be complex, but IFRS 3 provides a framework for this process. Companies have to assess various factors, including changes in the market, the performance of the acquired business, and any events that might have tarnished goodwill's shine.
So it's like a financial health check for goodwill, making sure it's still fit and strong.
That's a great way to put it. And these checkups need to happen regularly, at least annually, to ensure the financial statements accurately reflect the true value of goodwill.
Okay, so IFRS 3 helps keep those balance sheets honest, preventing companies from propping up their value with inflated goodwill. But let's shift gears a bit. You mentioned earlier that IFRS 3 sometimes provides exceptions to the general recognition and measurement principles. When do those exceptions come into play? Is it just a free-for-all?
Not at all. These exceptions exist to address specific situations where the standard rules might not quite fit the bill. It's like having a braai. Sometimes you need to adjust the heat or add extra wood depending on what you're cooking.
Ah, I see. So it's not about throwing the rule book out the window. It's about adapting it to fit those unique South African flavors.
Exactly. Take contingent liabilities, for example. Remember those potential obligations we talked about, like pending lawsuits? Well, in some cases, it might not be probable that a company will actually have to pay out. But IFRS 3 says that even if it's not probable, the company still needs to recognize that contingent liability, if its fair value, can be reliably measured.
So it's like acknowledging those potential rain clouds, even if you're hoping for a sunny, bright day, better to be prepared.
Precisely. And this exception ensures that the financial statements paint a complete and transparent picture of the company's financial position, even if some of those liabilities are a bit hazy.
Okay, that makes sense. It's all about being upfront and honest, even when dealing with those what-if scenarios. But what about those times when a company acquires a right that they had previously granted to the acquiree? Like, say, a big company buys back a franchise license they'd previously sold. How does IFRS 3 handle those reacquired rights?
That's another fascinating exception. When a company reacquires a right like that, they have to recognize it as an intangible asset, separate from goodwill. And the measurement of this reacquired right is based on the remaining contractual term of the original agreement, even if the market might consider potential future renewals.
So it's like recognizing the value of bringing that franchise back into the fold, but without getting too carried away with speculation about future renewals, sticking to the facts and figures of the existing agreement.
Exactly. IFRS 3 keeps us grounded in reality, even when dealing with those intriguing scenarios.
IFRS 3 really does play the role of a financial detective, carefully scrutinizing every aspect of a business combination. And speaking of scrutiny, let's talk about taxes. How do those factor into the world of business combinations? Are they just an afterthought?
Taxes are definitely not an afterthought. While IFRS 3 doesn't directly address taxes, it works hand in hand with another standard, IAS 12, which governs income taxes.
Ah, so it's like a tag team effort. IFRS 3 handles the combination itself, and IAS 12 swoops in to tackle the tax implications.
Exactly. And this is crucial because business combinations can create all sorts of tax complexities, deferred tax assets, liabilities, you name it. IFRS 12 makes sure these are properly accounted for, keeping everything aligned with IFRS principles.
Okay, I'm starting to feel like an IFRS sleuth myself, uncovering the hidden layers of these financial transactions. But before we wrap up this part of our deep dive, can we touch on a few more of those exceptions? I'm particularly curious about employee benefits and how those are handled during a business combination. They're a big part of any company after all.
Absolutely. Employee benefits are a key part of the equation, and IFRS 3 doesn't overlook them. It defers to IAS 19, the specialist in employee benefits, to ensure those are accounted for correctly during a business combination.
So it's another tag team effort. IFRS 3 passing the baton to IAS 19 when it comes to those employee benefits. It's like a well-coordinated relay race, ensuring everything is covered.
That's a great analogy. IFRS standards are interconnected, each playing its part to ensure a consistent and comprehensive approach to financial reporting.
Well, folks, we've navigated the intricate world of IFRS 3 reporting requirements, exploring those detailed disclosures that shed light on the motivations, the players, and the potential risks involved in business combinations. We've also delved into the fascinating world of goodwill impairment testing and those exceptions that showcase IFRS 3's flexibility in handling unique situations.
And remember, those disclosures are not just for the accountants, they're for anyone interested in understanding the financial heartbeat of these corporate mergers. They're the clues that help us decode the financial narrative.
Exactly. And in the final part of our deep dive, we'll step out of the theoretical and into the real world, examining how IFRS 3 plays out in some South African business combinations. You know, the ones that have made headlines. We'll see how those principles translate into tangible examples, giving you the tools to analyze those corporate maneuvers like a seasoned IFRS pro.
We'll unpack those real-life case studies, highlighting how IFRS 3 helps us understand the financial forces shaping the South African business landscape.
Stay tuned. Welcome back to the Indubo Knowledge Cast for the grand finale of our IFRS 3 adventure. We've, trekked through the dense jungle of definitions, navigated the tricky terrain of goodwill, and even encountered a few exotic exceptions. But now it's time to emerge from that theoretical wilderness. See how IFRS 3 plays out in the real world?
Yeah,
Right here in sunny South Africa.
that's right. We've armed ourselves with the IFRS 3 toolkit. Now let's see how those tools are used to build, renovate, and sometimes even demolish those corporate structures, the ones we see making headlines every day.
Exactly. So for this final act, let's put on our, financial detective hats and examine a real-life South African business combination, one that's been in the news recently.
Well, how about we take a look at the recent merger? In the banking sector, it's been a hot topic, with two major players joining forces to create a financial behemoth.
Ah, yes. That one's been making waves. Everyone's talking about what it means for customers, competition, and of course the bottom line. So let's break it down. How did IFRS 3 come into play in this mega merger?
Well, first off, IFRS 3 helped us determine who was the acquirer in this scenario. Even though it was presented as a merger of equals, IFRS 3 requires us to look beyond the marketing spin and determine which entity actually gained control.
Right, because even in those mergers of equals, someone has to be holding the steering wheel, so to speak.
Exactly. And by analyzing the details of the deal, the share exchange ratio, the composition of the new board of directors, other factors really, we can use IFRS 3 to determine who's really calling the shots.
Okay, so we've established who's driving this newly merged financial machine. What else can IFRS 3 tell us about this deal?
Well, IFRS 3 guided the companies in determining the acquisition date. Remember, that's not necessarily the day the deal was announced or even finalized. It's the day control was actually transferred. And that date is crucial because it sets the starting point for all the financial reporting that follows.
So it's like marking the official handover of the keys to the new financial headquarters.
Precisely. And IFRS 3 also helped ensure that the consideration paid those shares and other assets exchanged was measured at fair value as of that acquisition date. This ensures transparency and prevents companies from playing, fast and loose with valuations.
Okay, so IFRS 3 is keeping things above board, making sure everything is valued fairly and accurately. But what about the juicy stuff? Did this merger create any goodwill?
Ah, yes, goodwill. And this is where it gets interesting. By applying IFRS 3 principles, the merging banks had to carefully analyze the fair value of all the identifiable assets and liabilities, the ones they were acquiring. This included everything from their loan portfolios and branch networks to their customer databases and brand reputation.
So they had to put a price tag on everything but the kitchen sink.
Pretty much. And once they had a clear picture of those net identifiable assets, they could then calculate goodwill, the intangible premium, reflecting the expected synergies, growth potential, and other benefits, the ones that come from combining forces.
Right, because sometimes two is better than one, especially in the world of high finance. But even with the most optimistic projections, things don't always go as planned, do they? What if those expected synergies don't materialize? Or the merger hits unexpected turbulence? Does IFRS 3 just let that goodwill sit there on the balance sheet, potentially inflating the value of the newly merged bank?
Not at all. IFRS 3 requires those banks to regularly test that goodwill for impairment, basically checking if it's still worth what they paid for it.
So it's like a financial checkup for goodwill, making sure it's still in good shape, hasn't gone stale.
Exactly. And if those impairment tests reveal that goodwill has lost value, the banks would need to adjust their financial statements accordingly. recognizing a loss. It's about keeping things honest and ensuring that investors have an accurate picture of the merged entity's financial health.
Okay, so IFRS 3 provides that ongoing oversight, making sure those balance sheets stay grounded in reality. But this banking merger is just one example. We've seen a flurry of activity in other sectors too, right? What about that recent acquisition in the renewable energy space?
Ah, yes, that was a fascinating case. With a major international player acquiring a promising South African startup, the one specializing in solar technology. And IFRS 3 was right there in the thick of it, you see, guiding the valuation of those cutting-edge technologies, those intangible assets that hold the key to a greener future.
Right, because in today's world, those innovative technologies, they're often worth more than bricks and mortar.
Absolutely. And IFRS 3 helps us capture that value, ensuring those intangible assets are recognized and accounted for transparently. This, in turn, helps investors understand the true potential of these groundbreaking companies.
So as we've seen, IFRS 3 isn't just some dry technical standard, the one confined to accounting textbooks. It's a dynamic force, shaping the way we analyze and understand the real-world drama of mergers and acquisitions.
It's the language of corporate consolidation, providing a framework for transparency, accountability, and ultimately trust in the financial system.
Well, folks, there you have it. We've journeyed from the theoretical heights of IFRS 3 principles to the bustling marketplace of real-life South African business combinations. We've seen how this standard helps us untangle the complexities of mergers and acquisitions, shining a light on those financial maneuvers that shape our economy and our investments.
And remember, even if you're not a financial guru, understanding the basics of IFRS 3 can empower you to make more informed decisions, whether you're evaluating a company's performance or simply trying to keep up with the ever-changing world of business.
So next time you see a headline about a merger or acquisition, think of IFRS 3 as your trusty decoder ring, helping you unlock the financial secrets behind those corporate shakeups. Until next time on the Indubo Knowledge Cast, stay curious and remember knowledge is power, and sometimes a bit of a laugh.